right, everyone. Welcome to the Viking Capital webinar. My name is Vikram Raya. I am the founder and CEO of Viking Capital, along with my good friend Ravi Gupta. And I have two all-stars here joining me, Judah Fold and Christopher Parinello. Gentlemen, welcome to the program.
Thanks, Vic. I think our investors are going to be thrilled. Learn about this one and all the new folks. This is a great entryway to Viking Capital for sure.
We're going to have a bunch of people from all over the country here. We're expecting several hundred people, either on live or also on the replays. If you hear in the preview, we were showing a little glimpse of the drone video, which you'll get with the full download of our content on our landing page. So awesome, guys. Let's get started. But with that said, I know where people are from all over the country. And here's my last poll. Who do you think is going to win the Final Four or the NCAA tournament? You guys can put in your little guesses here. Anyone have any winners? Okay, we got UNC. Anybody else?
Sims in Dawsonville.
UConn, UNC.
I'm going to go UConn. My son's bracket's already completed, so.
Okay, good.
I'd
All
love
right,
for it
guys.
to be the Gators, but I'd have to go with Arizona. I think Arizona's got it this year.
All right, guys. So this is the lay of the land. We're going to go through, talk a little bit about us, introduce us for the new people. For the people who know us, welcome back. Thanks for being a Viking investor. We value so much. You helped us grow our portfolio and our company, and we're so excited to help you grow your wealth and have innovative strategies to grow and create freedoms for you guys. And with that said, a little bit about our story. I'm not supposed to be here, guys. I'm supposed to be in a cath lab somewhere trying to do an intervention on a person who's had a heart attack. That's right. My background is not in real estate. It's not in commercial finance. It's actually in cardiology. That was my initial passion, and I really love doing it. I scaled a practice with a group of partners in in the DC, Maryland area. And I fell in love with real estate as sort of a side thing in 2012, and it just built and built and built. And then, I was looking for financial freedom myself as a physician. A lot of my friends who were lawyers, engineers, doctors were also looking for financial freedom. And so as I started investing in deals, they started joining me, and one thing led to another. And Ravi, who also is a physician, is my co-founder. We started Viking Capital with the dream and sort of the promise of, hey, can we figure out alternative investments besides the stock market? Is there wealth without Wall Street? And in our case, the answer was yes. It's not saying we don't still invest in the S&P or in NVIDIA. I wish I invested a long time ago. But that being said, we wanted to figure out, is there a way to create institutional level quality investments for high income earners who are looking to diversify, who are looking for tax savings, who are looking to create generational wealth. And that's what led us to multifamily. And so over the years, we started Viking specifically in 2015. We just grew the company and started being a regional player, and then slowly started becoming a national player. And we started bringing really high quality people on our team, each of them who has an expertise in different areas. And one of the themes I want you to learn about our company is these 5 things: cash flow, the tax efficiency, diversification, not only within other asset classes and real estate, but within real estate and even within multifamily. We diversify by buying in properties in different locations and different actual strategies of these kind of deals as well. Obviously, you're going to grow your equity, and you're going to create equity, and you're going to grow appreciation. So next slide. Quickly, let me give you a background on my two co-hosts. So Judah, again, as I joke that I'm a recovering cardiologist, he's a recovering attorney, and his legal acumen and background has really helped him really take Viking Capital's acquisition to the next level. And really, he spearheads our acquisitions across the United States. He runs his own team, and he's able to find from 2,000 deals a year. He's able to find the 5 to 6 juiciest deals and presents it to us as a team, and we decide which ones we're going to go after. So we really try to find the diamonds in the rough. Again, thank you again, Judah, and I'm excited to hear your comments on the program. Chris is our director of investor relations. What that means essentially is he is the guy that interfaces with all our investors. I mean, we have probably between 700, 800 investors all over the country. We have about 30,000 people on our Viking investor list that, are always curious about what deals we have and what offerings we have. And his team really makes sure education is number one for our company. So he happens to allow people to get into our investments, but his primary focus is helping the investors get educated about all aspects of their investor journey. And that's what I'm so proud of our team for, because we want people to understand the possibilities, the opportunities. And if our real estate investment does make sense, then we'd be happy for you to join us. But we even give you analysis on other people's deals because we really want you to have an unbiased opinion. So awesome again, Chris. I can't wait for you to interface with some of the new people that are going to be joining us today. Again, my background, as I mentioned, practice cardiologist for many years. The success of I've been a serial entrepreneur. I've formed several other companies that are all quite successful, but really my focus here is on Viking Capital. And we've really grown it to about now we have $800 million of assets. We've raised about $300 million of private equity. We've been featured on obviously all these places. Next slide, please. And as I was mentioning, the reason why we've been so successful is because we've really found, our aces and put them in their places. So these all-stars are all domain experts in their respective fields: asset management, marketing, investor relations, strategic planning, finances. So that has helped us sort of create the high touch environment that people want nowadays versus the big box institutions. But we have the institutional level professionalism, and now we're starting to get that scale and track record that can warrant, favorable terms and economics among lenders, buyers, and brokers. This is, again, close to 5,000 doors we've acquired. And this is something I really want to focus on here. In this age of volatility, right? We're in 2024. We've had a really good run from the post, great financial recession, which happened in 2008. There was a long run of success in all real estate asset classes, including multifamily. But when the COVID hit and there was some volatility, and then obviously there's an infusion of capital and liquidity into the markets, then once the inflation started hitting and they started ratcheting up interest rates, there's been a tremendous amount of volatility in multifamily and other asset classes. And, there have been some even more established players who've not been able to keep up, if I can put it that way. And one of the things I'm super proud of is we've never lost a single investor dollar. We've never done any capital calls, and we really focus on capital preservation. That being said, we're not here just for capital preservation. We want to grow our assets. We want to create cash flow, and we want to become super tax efficient. And so we'll talk about all that today. I think we've discussed this next. So, as we've grown over the years, we've been proud to say we've been getting a lot more investors in different parts of the country. And so I think we've hit 94% of the United States. There's a couple of people out there we need to get. So if you know anyone in Alaska, or is that Nevada? I'm not sure what state that is there, but yeah, we need to get them on board. Wyoming, perhaps. That's your job, Chris. Let's get some of those guys on board.
We have people in Nevada and Wyoming, so I don't know what.
All right. So before we get into the deal, I just want to have 2 or 3 slides on some of the dynamics. The reason why we're still bullish on real estate and on multifamily is this. Wall Street Journal is saying it's never been more unaffordable to buy a home, right? The reason is interest rates are super high and there's not much inventory on the market. Everyone who has a good home or has a good rate is sitting on it. So that's making it even now when the interest rates are high, it's still expensive to buy a home. And so that's sort of the challenge here. And so what that means as apartment owners is people are going to be renting for a long time. There is going to be consistent rental demand. I think the last data, Judah, that you had presented to us as a group was there's 5 million units shortage in the United States of rental of units for living. And so, and on top of that, we are buying in select markets. We're buying in the Southeast. We're buying in growth markets like the Atlantas, the Texases, the Phoenixes of the world, right? And so in Indiana's, right? This is where people are moving out of the Californias and the New Yorks and the Chicagos because, they're remote working, favorable demographics, favorable employment. These are growth areas. And so those areas even have further supply demand mismatch. Next slide. Next. And Chris, as he's talking to more and more investors, we're all noticing a trend. It's the millennial generation that's driving this rental growth. They're delaying when they're getting married. They're delaying their first home purchase. And so what that means is most of these people are not creating new households, or usually, they're attractive to the rental lifestyle. And even when they're ready to start buying a home, this huge interest rate hike happens, and it's still unaffordable for them. And so 63% of people between the age of 20 and 34 are living in rentals. 39, almost 40% of people 35 to 44 are living in rentals. Next. The good thing though is the incomes are keeping up with rent. So even though rents were skyrocketed and then there was a little bit of a pause and the stability and slight downward tick in some markets in rent, overall rents are still pretty consistently stable, and they're on the uptick again. But the good thing is income is also going up as well. So people have the right amount of prosperity to live in rental units and pay for even upgrades and higher level rental units. And the ratio we like to look at is 3-to-1. So if the person's income on a property is 3 times the rent, that is a very healthy ratio. And we've done that on all our properties, and it usually hits that or exceeds that.
To give context here, it would have to be 33%. And as you see on that chart, we're hitting a max at 23%. That's, a 10% cushion, which really affords us a nice opportunity going into a property.
Next slide. So now the question is, hey, do we have a crystal ball? What's going on? Well, today we found out they did not cut rates, which for most people are like, they're upset. Chris, tell me why you're actually geeked out and excited the fact that they did not cut rates.
Yeah, I think, what happens when the rates cut is that institutions are going to come back to the market, and we're not going to be able to buy deals like Dawsonville at such a discount. So I think I would always make the argument to investors, or even to, Vic and Ravi, as we're looking at deals, is I'm actually rooting for the rate to stay high so we have more buying opportunities. It puts a little bit of stress on some aspects of the market, but it really allows us to get an incredible basis.
When rates are high, there are a lot of buyers who are on the sidelines, not even looking. And as Vic mentioned before, we may look through 2,000 deals to find that one or two. When a lot of groups aren't even looking because the odds are short, they're going to find something. It allows us to be one of the sole groups that really uncovers the diamond in the rough.
Next slide. So to be in real estate, you have to be a student of economic cycles. And this is what we really focus on in Viking Capital. We really try to, there's a quote. It says, history doesn't repeat itself, but it rhymes. And so after studying the 2000 crisis, after studying the 2008 crisis, after studying COVID, and now what we're in now, you sort of get a sense of where things are going to go and where things are. And so right now we're in what we call buyer's market stage one, where there are select deals out there, and they have cash flow, but they're few and far between. And so if you can find something like that, go ahead and buy. Otherwise, most people are, like Judah mentioned, are sitting on the sidelines. And so we really have a window based on, I was at an economic forum meeting in Whistler, Canada, and there's a couple of billionaires there and a lot of really powerful financial tycoons. And what they were suggesting is they're suggesting June is probably the first rate cut. And they may not, they're predicting probably not many rate cuts, but probably 2, maybe 3 at most this year. But the problem is the moment the rate cuts happen, things become more affordable. Right? You can use more leverage to buy a deal, and prices will go up. And so really, it will probably signal the start of buyer's market stage 2, where now more and more people are starting to come in. People are coming off the sidelines. Right now, pencils are down. Now people are going to pick up their pencils and start underwriting. So I think we have an unusual opportunity for the next 3 to 4 months to buy as many deals as possible before the whole market wakes up upon the initiation of those rate cuts. Next slide. So some of the key advantages here, we've talked about already: baby boomers, millennials, right? Downsizing the baby boomers, upsizing or still renting the millennials. We got overall rent growth coming back online. We got strong exit opportunities with this deal because of economies of scale that we have. And we own 9 other deals in Atlanta. So this would be our 10th deal there. And so what that means is we can bundle things together. We can be efficient with our operations and things like that. Next. And so with all that said, I'd like to present our latest project. So this is our 26th offering, Dawson Forest. It's a 268 unit property located in the northern Atlanta suburbs. It's on a really powerful artery called 400 North. And this is sort of a really impressive artery of over, let me see if I have the data here. It's 16,000 businesses along that core technology corridor with 200,000 employees. And Dawson, as you know, is one of the fastest growing counties and cities. And again, not to be confused with the pretty favorable show people liked in the late 90s, Dawson's Creek. Next slide. But it's this technology corridor on 400 North really is a mega attraction for a lot of employers, a lot of people who want to live there. It's a lot of growth going on. And Dawson itself, Dawsonville, has been growing 20% year after year. And so again, why do we love this deal? And if you have to leave, then this slide is the most important slide for you, along with the slide that Chris is going to talk about, where he talks to you about the pretty attractive returns we're going to provide on the deal. But here's why I love the deal. First of all, it's 1999 vintage. That's amazing, right? The newer the deal, the less maintenance, the less deferred maintenance, and the better shape it's in. So this is essentially an early 2000s deal, so only 24 years old. Number 2, it's a perfect size, 268 units. It's a perfect size for us to manage. And 2, it's a perfect size that other institutions want to buy from. So, we're on Blackstone's preferred buyer list, right? So if Blackstone, we want to sell this deal to Blackstone, they'll scoop it up in 2 seconds. Number 3, this is institutional quality. So, the quality construction, quality interiors, and quality tenant base. This is something that most people want to get it themselves into. Next, it's around a strong retail complex. It is across the street. Literally, you can throw a football. If you're in the parking lot of Dawson Forest, you can throw a football into the luxury premium outlets across the street. So this is like the Gucci, the Prada, what is it? Not, I was going to say Sarah Blakely. No, it's Tory Burch, all the Prada, all that kind of good stuff. It's all literally across the street. There are huge box retailers. There is we're sharing a property line with Home Depot, a Super Walmart, there's a PetSmart. All of that's just right there. And the interesting thing was 20 years ago when they built this deal, this was very low density. This was super low density in 1998. And now in 2024, it's high density. And there's about 700,000 square feet, 700,000 square feet of premium retail. And also in terms of, our business thesis or our investment thesis as Viking Capital is this. It is, we love value add. And what we mean value add is really, how do we infuse capital into a property that enables us to increase NOI or net operating income in order to increase the value of the property, right? There's two ways to increase the value of the property. There's organic appreciation and forced appreciation. And Judah, his team, Ed and his team, and everyone else on Viking, we've figured out how to squeeze the juice out of both. And so we do organic appreciation and forced appreciation. So that's why this deal is really exciting. 70% of the units are ready for upgrades. And what else can I say about the deal? There is competition. There is other apartments in there. The interesting thing is they all built recently. So there are like A-class properties, 3 of them, and we're the only B-class property there. So we're the most affordable option. And when you look at our property, it looks actually very good and it can compete with some of those other properties. But we are purposely trailing, and we don't mind trailing the whole time. But the rent growth we're seeing from the classic units to the upgraded units is almost $300. And so these are all the reasons why this deal, and again, is so exciting to us. And then let me go to the next slide. And this was initially the guidance on this deal, or what the brokers thought this would go for, and what the sellers thought they wanted was $58 million. This eventually got negotiated down to about $54 million. And then after it was under contract, our partners and I were able to negotiate it down to $52 million. So this is a $6 million discount off top line pricing. And that's why we're able to do it at a 6 cap, which is highly unusual in Atlanta, especially with this kind of property at this vintage. Next slide. So next slide here. Okay, we'll let Judah here.
Yeah, thanks, Vic. Yeah, I mean, with all that good news on the property, you'd think there'd be not much more to say, but surprising on this one, there really is. Just to go over a few of the numbers really quickly, Vic mentioned this is a 6 cap, right? Right now, you're not seeing deals in Atlanta trade for a 6 cap unless you're willing to go to C properties in C-class areas where it takes that high of a return profile to justify the higher risk. This is a good area. This is a B-plus property in a B-plus area with A properties that have come in to try and compete with it. So to get a 6 cap as a return rate on trailing 12, not even trailing 3, just speaks to the high level of return that we're getting at this basis. Everything looked good on the property. One thing that has to be mentioned on the expense ratio was that there are some properties we come in saying, hey, we can operate it better than the last guy. Here, we've been tracking this property for years, actually. That's because the property management firm that we use was also the property management company of choice of the seller. And we knew that when they finished their business plan, there was going to be meat on the bone left on this one. And we've been tracking it for years. We know it's been well maintained. It's been well taken care of. There are much fewer skeletons in the closet. And also, when you have a property on site being managed by a team that's going to be staying on site as the new team, they're incentivized to keep operations as high as possible. Occupancy is 96%, and it's important this is planned to be a 5-year hold period, and Chris will soon get into all the investment classes as well. What the next slide shows, though, is really important, and this is kind of the organic rent growth. Now, right now across the country, and I see people in the comments asking about rent growth in different parts of the country. Let's talk about rent growth in Atlanta for a second. Rent growth in Atlanta has historically outperformed over the last 5, 10, 15, 20 years. Over the last 12 months, it slowed down a bit, and we're just now starting to see it come back into the fold on our other properties, seeing really 2-3% kind of historically strong rent growth. This property in this pocket has consistently seen 5% rent growth over the last 18 months when other properties, other markets, and some markets have slowed down. And that's because of what Vic described earlier. There is simply not enough apartments in this area, and the other apartments that came in overshot rent much higher, leaving this very attractive property as the low cost alternative, which is why it stays so occupied, even though they're turning out rent trade outs at 5%. As you see in the bottom left here, $140 in rent increases for doing absolutely nothing, let alone the value add plan we have in place that's been proven out by the seller that we'll go into in a moment. All right, so let's get into the investment summary here briefly. There will be a 3-tier return structure, and this is where I get to hand it over to Chris, who can give a lot of detail on how and the different ways you'll be able to invest into this property.
And before you hand it over to Chris, I just want to say, look, guys, we love options for our investors. And if you like drinking wine, we've tried to create some options here. So you can drink the blend, you can drink the reds, you can drink the whites, the Merlots, the Cabs, or you can combine them. And so there are 3 distinct classes that Chris is going to go into, but there's also people who love to combine things as well.
Thanks, Vic. That's a great analogy. Yeah. So what you're dealing with here is a 3-class structure. You have Class A, Class B, and Reserve. The way that I like to try to explain this to investors is in correlation to risk. So Class A, you are getting a 10% preferred return, and we're anticipating that that's paid current. A 10% current means that if you put $100,000 in, the annualized percentage at 10% is going to be divided by 12 months, and you're going to get that every month. It isn't a guarantee that you're going to get it, but the reason that you're taking on a little bit less risk is you're prioritizing the cash flow. So before B and Reserve get their cash flow, Class A gets its 10%. Now, the downside to Class A and what you're giving up is you're giving up the back-end equity split. Now, Class B is giving you a 7% preferred return, and we'll go through what the cash flow looks like for B and Reserve on the next slide. But you're also getting a 70-30 profit split on the back end. With Reserve Class, it really emulates B. But what Reserve Class is a significant enhanced return metric for folks that are investing $500,000 or more.
And you can see here the minimum investment for Class A and Class A and Class B is $50K.
Exactly. So here you get to see our capital stack. You have the Reserve Class, you have Class B, you have Class A, you have equity, and you have the debt. So as you move through the stack, it shows you who has priority to the cash flow. So first the debt gets paid, then the cash flow goes to paying the equity current, the Class A current, and then B in Reserve. On the right side, you can see some of the analytics of the purchase price, the debt total, and the total equity. And then what we envision as far as how much of each class there will be for Class A, Class B, and Reserve. So with this investment, we launched this to our internal group of investors, and Class A filled up rapidly. Within a week, it was full. So that class is closed right now. And the reason that we only take 1.4 million, it's usually 10% of the total amount of equity, is because we need to ensure that we're going to be able to pay that current pay. That class for other future deals is a 1.5x equity multiple, which is pretty simple. You're getting 10% over 5 years. It equates to a 1.5x. Class B and Reserve are going to get that 7% and 8% respective pref. The equity multiple is 1.9x to 2.1 for B and 2.1 to 2.3 for Reserve. The average cash on cash is the same. They're paid pari passu and for both B and Reserve, which just means they're going to be getting paid equal cash flow. And the IRR is a range. We say 16, it's really 15 to 16% for Class B, and Reserve Class, it's going to be 16 to 18%. So this is a really great tool for everyone that wants to understand exactly what those numbers we just went over look like through a $100,000 investment. And then at the bottom for the Reserve Class, a $500,000 investment. So Class A, just as we discussed, you're getting a $100,000 investment is getting a 10% return annualized. So that's going to be broken up into your monthly distributions. Viking always pays its distributions monthly. And it's going to go year over year until year 5. And then when we dispose of the property, you're going to get your $100,000 back, and you'll have already received your $50,000 of returns for a total expected return of 150, which is at 1.5x in play. For Class B, you're getting what we project as a 4.5% annualized return in year 1, and it trails up to 5, 6, 6, and then 7% in year 5. So the annual distribution for each one of those years is 45, 5,000, 6,000, 6,000, and 7,000. Now, when we dispose of the property, unlike Class A, you're going to be getting your equity split. So the way the equity split works is 70% goes to you, the investors, 30% goes to Viking as its promote. So your portion as a $100,000 investment equals $72,500. Now you add that to your return of principal, which is the $100,000 you invested, and the cash flow that you've already received, and now you've doubled your money in 5 years. you have a $200,000 total return, including your investment. Now, reserve, what this illustrates, you'll notice the 22,500, 25, that's just these multiplied out by 5 times the investment. But what's more powerful for reserve class is you're getting an extra 10% of Vikings profits. So reserve getting enhanced economics doesn't hurt B, it doesn't hurt A. It's Vikram and Ravi, our principals, saying, if you invest 500,000 or more into one of our deals, we're going to give you 10% of our profits. And we're going to reduce our upside to 20%. So that equates to a $457,500 upside at disposition. And you've also received, the cash flow that you've received over the whole period for a total expected return of $1.1 million, along with your $500,000 back totals at $1.1 million. Now, keep in mind that these are the middle of that range that we gave. So they're not guarantees, but through our 25 deals, we tend to fall within that range. Is it going to be on the low end? Is it going to be on the high end? That's really going to depend on the exit economics and where we position this as from an exit cap rate perspective. Okay, so this is always something that is incredibly interesting to new investors. Folks that have worked with us for many deals in the past have been tracking this quite diligently. All of these deals, by investing as a limited partner, you also get pass-through tax benefits, and that's called bonus depreciation. So what we're doing as sponsors is we're taking the property and we're doing a cost segregation study. We usually do a preliminary one right when we get it under contract. And then all of that bonus depreciation that gets accelerated gets divided by the amount of equity that comes into the deal. And when you get your K1, which is how we report your investment amount, how much you've made, and for you to report on your taxes, in box 2, you're going to have a loss, a real estate loss that is going to encompass your share of the depreciation that this asset created. Now, when the IRS started this program and this initiative in 2017, they envisioned it going from 2017 until 2022. In 2023, you started a step down process. So deals that were purchased and put into play in 2023 got 80% bonus depreciation. So if the property created $10 million in bonus depreciation, in 2023, you multiplied that times 0.8, now you could capture 8 million. That gets divided by the equity. One thing to keep in mind is that Viking Capital keeps none of that bonus depreciation. It's all given to the LPs. The GP takes none. 2024, you have an opportunity to capture 60%, which, in that example, $6 million now divided by the equity. So one really important factor that we've been tracking diligently, and I know a lot of you have as well, is that Congress has already approved the reinstitution of 100% bonus depreciation. That is where everyone thought it was going to have the most trouble because it was going to need bipartisan support, both from the Republicans and the Democrats, to put it into play. And that was approved at the negotiating of including a child tax credit for the Democrats to meet in the middle. Where this is right now is it has been pushed to the Senate, and most pundits believe that this is going to get approved and we're going to go back to 100% bonus depreciation through January or December 31st of 2025. So in 2026, if everything approves, it would sunset and it would need more legislation to keep it going after that. But that becomes incredibly powerful because deals like this will go back to producing a much larger amount of bonus depreciation, which you'll be able to use to offset any passive income that you have, whether it's from this investment or other syndications that you're in, or you sold your business and you have a big waterfall of capital coming in due to a sale to private equity. There's lots of ways in which for you to use this benefit. And I encourage everyone to reach out to my team, book a call, and let's talk about your situation and see if it would qualify.
All right. Thank you, Chris. Judah, let's get the debt. People are asking, is it fixed? Is it floating? What's the rates? Let's show them the numbers. You're on mute, Judah.
Yeah, no, this is going to be a well-capitalized deal. We've already had the debt team been working on this for months already. We are looking at a fixed rate loan, most likely from Freddie, but if not one of the agencies. We got quoted at a little over 5.5% loan. Again, if you remember from earlier, 6 cap rate, 5.5% loan, that's positive leverage. What kind of helps make all these deals work? 2 years of interest only payments, closer to 70% leverage. Again, we haven't seen that leverage in a couple of years now. The stronger the returns get on day one, what you get with the 6 cap, the more proceeds we get. So fixed rate, competitive rate, and a couple of years of interest only payments so we can ramp up the business plan. All right, this is a slide. I'm going to touch on it briefly. This is what we love showing investors. We make our own assumptions. We do it carefully. We choose what we think the exit cap is going to be. We choose, all these different assumptions. Take a second. You should think, well, where do I think cap rates will be? in 5 years from now when we sell this. And based on that, you can see how that would impact the returns here. Here, it really stays strong across the board. We think that cap rates will probably be, if you ask me, probably lower than 5.5%, but historically, conservatively, 5.5% is a good estimate. And that shows pretty strong, almost 2x multiple and near a 20% average annual return. Now it's Class B. Class A, again, same assumptions, but given the improved economic terms for those 500K plus investors, it does allow for a little bit more on the multiple and a little bit more on the average return. All right, now here's where I get excited, right? Here we go, spreadsheets, right? I live in these all day. It's where I kind of crunch the numbers, and it's what gets me excited when I find a deal like Dawson Forest. If you look on the bottom here, the net operating income, right? That's the income less all the expenses. That's what values a deal. How you finance it, whoever buys it from us, they may pay all cash. They may use a loan, anything in between. NOI is what drives value. We forced depreciation, what Vic mentioned earlier, is how we create value. We're taking NOI here from 3.3 million up to 4.5 million. That 1.2 million NOI growth, that is nearly 22 million in growth of the value of the property. And that's the opportunity we have here. That is a lot of value to add. It's what offers our investors all the upside as we execute our business plan. And by the way, any questions on that, reach out, book a call. We'll get you details on how that happens. We want to make sure we're getting through this so we can head to Q&A, as I know a lot of you are looking forward to that. Great unit mix here, by the way. Not only are nearly 70% of the units prime for upgrades. Now, what that means is that close to 32% of the units have been renovated. Built in 1998. It looked, probably the architect started working in 1995. The original units look dated here. Now, they're still getting strong lease trade outs, but the seller has taken 32%, renovated them, and shown the ability to earn up to $300 rent increases for those renovations. We have nearly 70% of the property. We can continue that plan, and we can be the one to benefit from all those renovated units and the rent premiums that go with it. And this is just an example. It doesn't, you don't have to be a real estate expert to see that what's on the left side, which is what the original unit looks like, right? When we transform it to the right two sections, but especially the right side, which is what ours will look like, people are willing to pay more for that. It's more attractive. It's got newer appliances. It's where people want to live. And that's really kind of what drives the plan. Now, we've put down $175 premiums, $250 premiums. They're getting north of 300 right now. Again, we just like to be conservative in how we underwrite the opportunities. Again, there's more pictures showing you that these are renovated units, a whole different world. It's what's driving that $300 rent premium. But by the way, that still trails the new product, the competition, by a few $100s.
Yeah, so the interiors of our units that are renovated, the high-end renovations, they're cheaper than the similar renovations, the similar level of finishes at these luxury properties. So of course, we're going to be full all the time, and we'll be the opportune choice for apartments.
And just to give you an idea of what we invest in, you might have seen on the slide, the fitness center, the clubhouse, the pool, and these are full service, luxury quality type amenities at this property. Again, what's drawing the tenants there? Like I said, it is a bit dated. We already have priced out and contractor selected to renovate the clubhouse. So when the tenants walk in, they'll see an updated fitness center, an updated clubhouse, and we'll attract the top tenants in the market to bring onto the property.
You can see a well amenitized property, pool.
Yeah.
There's playgrounds, there's grilling stations, there's a dog park, package lockers, fitness center. There's a cyber cafe. It's a well amenitized.
Yeah, there are amenities that appeal to all types of renters, families, people who are single, which is great. It's a diversified tenant base. We have a really diversified set of employers. We have med, we have ed, we have teachers, we have retail workers, office workers. You can see here, surrounded by retail, surrounded by a lot of what's driving jobs and tenants.
Yeah, can you go back 1 second? I just want to show. Okay, guys, look. So those two are. I think this is a Home Depot here. I think that's the Walmart. Here's the luxury premium outlets right across here, across the street where it's located. So with this all within walking distance. So that's why this property is just so unique.
And again, this is what's really the meat and potatoes. If you look at our property relative to the other ones in the market, our rents are simply lower, and there's room to grow them, and it's still going to keep us occupied. That means there's upside and extreme downside protection. Those two together are what drive opportunity. Again, what got us first looking at this here is the market, the location, high income that's grown over the past few years, population that's grown, an educated population, high white collar employment, people who have good jobs. What that means is that they can pay their rent, they can absorb the rent increases, and they have a demand for a higher quality product as well. Sorry, Vic. Sorry, you were going to say something.
No. Keep going. You're doing good.
All right, go forward one more. This is what Vic referenced earlier. This is, again, what brought our attention to this submarket. People are moving here and they're following this 400 corridor that Vic mentioned earlier. This was ranked number 3 in the growth of counties in the US. People are moving here for a reason. It's for the job, it's for the space, it's to be a little bit less traffic, and the retail and all the employment opportunities. And thankfully, there aren't enough places for them to live, which is why we get the opportunity we get. And now again, Georgia, rent growth is something that's been going on in Georgia for a reason. If you follow the elections, if you follow what's going on there's a reason that all these fights are happening in Georgia and Atlanta. A lot of people are moving there. There's a lot of change going on. All that's maybe not great for some of the political parties out there, but it's great if you want to be multifamily because it means people are moving there. That's what's causing all this change. That's what's causing all this friction, maybe in politics, but in multifamily means one thing. It means rent growth and high occupancy. And again, even within other submarkets in Atlanta, you can see Dawsonville presents a good option. It's affordable. The rents have grown. It's a combination of rent stability and opportunity.
Okay, so this is where we were mentioning there's so many, there's all these new deliveries that happened from 2018 to 2023. There's, I think, close to 1,400 units that were delivered and that were quickly absorbed because there's such a shortage of supply in this area. And what that means is there's no new supply coming. There's this clear distinction between our property and the 3 or 4 luxury properties that are there. And so this is giving us almost like a monopoly on B class, B plus class housing. And even if we raise rents, we're still going to trail the competition by $300, $400, $500. And this allows us to remain full and execute our business plan. And in terms of the hospitals, we're 30 minutes away from a level 1 trauma center, which is a 600-bed hospital. And if you're in the medical space, those are really hard to find, those big hospital systems like that, 600 beds, 14,000 employees. So that's why we're seeing, medical people on our property because it's only within 20, 30-minute driving distance. We've already mentioned the outlets that are right across the street, creating a tremendous amount of foot traffic and vehicle traffic to Dawson. And then they're all the hubs of employment. Microsoft is a huge presence there. Northside Hospital. Alcon is an office park with 41,000 employees. Atlanta is only a 45-minute drive. Gainesville is the poultry capital of the world. That's right, my friends, chickens. And it's Purdue, Tyson, and it has $22 billion of impact on the U.S. economy, that poultry economy, which is based out of Gainesville, which is right next door. Okay. Again, we know Atlanta's one of the busiest airports in the world, a tech hub. Let's keep going. The interesting thing about Atlanta is it is a growing gangbuster. Right now, I don't know if this is accurate, 6.1 million. We're rapidly approaching 7 million. I think it's ranked as one of the largest cities in the country now. And the Fortune 500 that was mentioned, that's really important because you want income, you want employment, and that creates stability in a submarket. And the more employers move here, the more successful they are, the more stable the regional economy is, which again promotes strong tenants and rentership. Next slide. In terms of sports teams, the full gambit, the Braves, the Atlanta United, the Falcons, the Hawks, CNN. So it's a big tourist destination. The World Cup is coming here in 2026, $17 billion of impact. In terms of other alternative kind of employment, next slide. We have the Hartsfield-Jackson Airport, the world's busiest airport, $71 billion of total impact. Next. We got the Atlanta Film Studios, which makes it essentially a Hollywood of the South, 4.4 billion economic impact per year. Porsche North American headquarters right near the airport, tremendous number of jobs, provides notoriety, a lot of traffic. And in terms of overall why Atlanta still excites us, it's outperforms in terms of business and rent. It's a pro-business climate. We talked about the Fortune 500. We talked about the favorable apartment economics and why this is a desired city. It's a thriving location for numerous reasons. And the coolest thing is affordability, right? You can have all these things, but if it's not affordable, then what's the point? The fact that it's still affordable is still why it's growing. The higher education, we've talked about how medical and healthcare is a huge component of a lot of Atlanta's growth. The logistics is important to mention. We've mentioned the airport. It has a ton of industrial warehouses. These are logistical, high-end warehouses that are very automated and very technical. The highway infrastructure allows someone to essentially reach 80% of the US within a 2-day truck drive. The railroads, CSX is there. The Port of Savannah and the Port of Brunswick, essentially huge amount of trade and commerce is happening, and they have to pass through Atlanta. In terms of specifically why Viking Capital is poised to really benefit from buying this additional asset is we already own 9 solid quality assets in Atlanta, and this will be our 10th. And so we can share personnel, we can share materials. The same property management company is managing all these. And so we have efficiencies and operational upside when we take this property over. And then finally, investing benefits, and then we're going to get to the Q&A shortly. So why multifamily? We've mentioned it already, but the cash flow, the long-term asset stability. This is not a luxury asset. This is a necessity asset. And one of the components of inflation is, rents and home prices. And so every year you have to reprice the rents to take into account inflation. So it's a hedge against inflation. Consistent housing demand, we've talked about that. If you do the right things, these things do appreciate over time. Tax advantages of owning this, and obviously diversifying your portfolio. So many people ask, hey, look, I'm interested. This sounds exciting. How do I get started? Well, obviously cash is the easiest way to invest. You can invest using a 401k or an IRA. You can consider doing 1031 exchanges. Depending on the size of your 1031 exchange, we do accept 1031 exchanges. Liquidating low performing assets and upgrading to high performing assets is the way to go. If you have a trust, there's another way to do it. So these are all the ways that you can invest. And Chris and his team are experts in helping people figure out what the best strategies for themselves and their family. And so with that said, again, quick highlight, 1998, please, previous slide. 1998 asset, 99 almost, 96% occupied, 70% to 18% IRR, depending on which class, 2x multiple, 6 cap, fixed interest rate, across from powerful retail, one of the strongest investments we've seen in a long while. And so, great, Vic, you've painted all the great news and picture. What's the downside? Well, as I mentioned, I'm a cardiologist. I like to stress test things. So if I had to manifest Dawson Forest as a human being and I put him on a treadmill and I stress test the hell out of him, what would I see? Well, there's a certain thing as asset risk, right? And so you could buy retail, office, hotel, multifamily. Well, I think within asset risk, multifamily, it has the safest risk profile. Then you can look at, what about a debt risk? Well, we're choosing a fixed rate debt. We've seen the challenges of floating rate debt in the past in our portfolio and other people's portfolio. And thankfully, we have strong fixed rate options with a low cost of money. And so we've chosen an agency loan that's fixed rate. Next is location risk. You can buy a great deal, but if it's in the boonies or if it's not in an area that people want to eventually transact with you, that's a risk, right? Well, this is in a strong location right on a main corridor and artery next to huge demographics and population growth. What about operation or execution risk? Well, guys, we've done 26, 27 multifamily transactions. We know how to execute and operate. We have almost $1 billion of assets. This is right in our wheelhouse. Okay, what about vintage risk or year that property was bought? Some people buy 1920s properties, 1960s properties. Thankfully, this is a 1998, 99, almost 2000 property. So that's sort of offset. What about competition risk? Well, there's 4 A+ properties in the area, and we're the only B property that we're about to convert into an A- and still trail those other properties and be 95 to 96% occupied. Okay, great. What about, due diligence risk? Well, we just finished due diligence early on. We went through the property with a fine-tooth comb, and we could not find anything that would make us concerning, and we feel very comfortable assuming this deal. What about timing risk? Well, right now, interest rates are stable, and we know that it potentially will drop. So we could only anticipate further upside in the future. And then finally, what about sales risk? Who would buy this property? Well, I think institutions would like to take this off our hands because it's an institutional level quality build, and it's in an A area, and it's a B+ property. And so if we take care of and do our value add business plan, I think we'll be in a good shape. So that's me testing the property, guys. And so with that said, thank you for the team. We'd love to answer any quick questions we have. But if you have any questions, book a call. Otherwise, scan the QR code. Try to get into this deal before it fills up. I know it will oversubscribe. We've also tried to be cute and come up with this thing called text wealth to this number. I don't know whose number it is, but hopefully it's one of our company's numbers, 205-316-2704. Text wealth there. We got our website. We got our email. There's multiple ways to get a hold of us. And then, guys, let's start tackling these Q&As while this QR code stays on screen.
Before we get to the Q&A, one of the things that I've started doing with all of our properties is I take our internal model I usually get a reserve investor or someone that's worked with us or a new investor. And I go through the entire thing. I talk about where I see risk, where I see soft spots in the deal, where I think we're being conservative or aggressive. I record it. That is available to everyone, as is the model. So reach out, book a call. A lot of these questions have to do with detailed questions about NOI and ROI and what the IRR is, what the exit cap is. We're not going to answer those here tonight because you're going to get all that information in the recording. If you get through that recording and you still have questions, book a call with me. We'll pull the model out, and one by one, I'll answer all of your questions and go through them personally on a Zoom call. That being said, let's go through some of the questions that won't be answered through a performer review.
Okay, one question I saw come in. Someone asked about the percentage of NOI. So the metric we look at is, well, one of the metrics we look at when it comes to percentage NOI is the percent of income that makes up expenses. Typically, you want to see that somewhere between 30 to 50. This one's about 37 to 39%. Unsurprising, again, we know the property management team that's on site right now for the seller. They're the same company that we use, so we expect them to see like a well-oiled machine. It tells us that they are appropriately expensing all of the repair items and all the operations on site. So again, that's healthy. Now we have obviously adjusted the taxes that might move a little bit with the acquisition. We've actually got a more competitive insurance plan that we will expend. So again, not much of a change there because we're keeping the same team on site. But 37, 39% is the expense ratio on this one.
Someone asked, hey, how many deals have you sold? We've sold 9 full exit. And that was our track record at the beginning, where I think we had a 24% average annual return. So yeah, we've definitely unloaded properties as well and gone full cycle, which is a good question.
Yeah, and if you want to learn more about those exits, there's a lot of detail we can go into, a lot of successful exits, a lot of stories behind them. Give us book a call. We're happy to tell you more about that track record. You will, I think, be pleasantly surprised when you hear how we exited and how we executed those business plans.
So again, this is going to be an opportunity for accredited investors. I know some people joined late. Hopefully there's some legislation going to be passed where even if you're not accredited, if you can take a test, I think the SEC will allow you to become accredited. So that we're hoping that legislation does pass. But for now, this is for accredited investors. And just as a quick reminder, 200K is a single, 300K is a couple, or $1 million of net worth outside of your primary asset. But we can help you see if we can qualify, by reaching out to our team.
Question on there is whether you can invest from 1031 exchange funds. We did talk about that on the webinar. The answer to that is there's a lot of questions we have to ask you in order to determine whether or not it makes sense, what your timing is, the leverage on your sale that necessitated the exchange. Call us. Let's talk through it. We would love to place your exchange and find the best opportunity to do so. So please give us a call on that one. The answer is yes. We take the exchanges. Give us a call so we can make sure it's done properly.
Yeah, typically our investment is 50K, but you always give us a call and we can see if we can work with you depending on what your question is. Okay, let's see any other big questions. And I know we can't get to everything, but let's see. Is Viking Capital an investing company or any of the heads of the company putting personal capital in the deal? Absolutely. In fact, the lenders nowadays require that. So we always have our own skin in the game, but really good question.
Someone asked about a further investment breakdown for further review. I can't really do that right now at the Q&A, but it's something we'd be very happy to do. Call. Chris is available. I'm available. We have a whole team available, making sure that you can look at the spreadsheet that excites me and see kind of where the value is being driven by. We'd love for you to understand that better, and we can spend time on a call doing that.
Yep. And then I think some questions about private equity. Again, that's a longer discussion, so please jump on a call with us. But people are asking again about the hold period. So typically our holds on all our properties are 3 to 5 years. Usually what we found is, depending on how the market cycle is, if we want to cherry pick the best time to sell to maximize profits for our investors and ourselves. So that's what dictates when we actually sell. But on average, on our 9 exits, we've held it for about 3.3 years.
The strategy here is a 3-year business plan. Some groups like to go in and basically incur a high level of vacancy so they can renovate all those units as quickly as possible. Different risk profile. We typically do it more organically, naturally. It takes about 3 years to do that. And then we have about 2 years. Again, we have a 5-year loan here. So we have 2 years where we can opportunistically and strategically choose the best time to sell the property.
Awesome. All right, guys. Very good. Thank you so much, guys. Scan the QR code. Be part of this investment if you can. I'm really excited for this one. We have already a tremendous amount of investor interest. So hopefully we can get you guys in this and we can form that partnership. If you're new to Viking, we'd love to get you to join us and help you grow your portfolio. So Chris, hopefully they have access to you. Judah, they have access to you and they have access to me as well. So I'm looking forward to it, everyone.
Absolutely.
Have a good night. Thanks for joining us.
Thank you, everybody.
Thanks, everybody.